So what does history tell us about how the markets perform during a government shutdown? How should investors position in the meantime? Let's ask our next guests, Capital Area Planning Group Managing Partner and CNBC contributor Malcolm Ethridge and BTIG Chief Market Technician Jonathan Krinsky. Guys, welcome. Malcolm, typically a government shutdown is something to shrug off or perhaps buy a temporary dip, but with the markets performing as well as they have in September and some of the stakes here, can we trust that playbook?
Yeah, I think you framed it perfectly. Historically, markets tend to perform at least flat during government shutdowns, and they don't tend to last very long. I think the longest on record was 35 days, and we just might be about to test that again, because I think this administration has already proven that it's willing to break with a lot of the norms that Congress tends to rely on. And so it is very possible that this one could have a lasting effect, which ultimately could be the catalyst to drive down a market that several analysts have already been calling for the last month or so, that we might have gotten overheated in the markets, and the AI trade specifically, it might be time for it to start to fizzle out.
Jonathan, what do you think about this? Because if history always panned out pretty much as expected, then we would have had a bad September, or at least a middling one, but September was really strong. So should we trust history when it comes to the impact on markets of a government shutdown?
Yeah, I think, a lot of times when you have these known events, context is important, and the preceding market performance into the event is also important. And so oftentimes you actually get some weakness into the government shutdown in anticipation, and that's why performance tends to be either decent or actually positive coming out of it. We didn't have that at all this time. You mentioned not only was September not weak like it often is, but ahead of the shutdown, we had no pullback. And so I think it could be a little bit different this time, but ultimately, whether the government shuts us down or not, that's not part of our process. There's a lot more things we're looking at right now, but I think context is important when you think about how markets perform during and after a shutdown.
Malcolm, we are about to enter literally hours away from Q4, and Mike Santoli was just mentioning some of the lingering concerns out there about consumer credit. We're not going to get the same kind of macro data that we're used to if the government does shut down. How much of a concern should that be for investors, given some of the macro and global headwinds that could be perceived out there?
Well, I don't know how much of a concern it should be. I'm going to agree with the context of your question that it probably should matter, but I don't think it really has, simply because since the April 9th lows, investors have really been focused on the AI trade once again. It's really been up to the Mag 7 plus a couple of friends to really do most of the heavy lifting. I know the financials have also done a great job of powering us to all-time highs too, but I think that that's really what the narrative that's going to hold through Q4 and on. I think that as long as the AI trade continues to hold up, we saw NVIDIA, for example, having great news through the CoreWeave story that ultimately looks like good news for them in Q3 and Q4. Those types of stories, especially as we go into earnings season, are really what's going to make the difference. And I think regardless of what the consumer numbers look like, maybe even the job numbers look like, investors are really going to be looking for cues for whether the AI trade can continue to power on.
Jonathan, what would you need to see in the charts to start raising concern for you about Q4?
Well, I think, again, one of the things is the backdrop. The S&P has gone 105 trading days without testing its 50-day moving average. That's now the fourth longest since 1990. Once you get over 100 days, the clock generally is ticking. But that just puts you on guard for maybe a 3 to 4% pullback, which we've seen in 18 of the last 20 years in the last 5 months of the year. So, that I think is perfectly within the realm of possibilities. It would feel a little bit ugly just because we haven't had one in so long. But to us, as we look into the fourth quarter and even into next year, we got to keep an eye on the consumer. Really the consumer stocks. And there's been different pockets throughout the last few months that have been showing weakness, but really the sustained weakness we've seen in restaurant stocks, some of the retailers, even the hotels are rolling over, airlines have been softening a bit. So there's a lot of parts of the consumer-facing market that have not participated in the latest leg of this rally. And if they were to roll over further, that would be a bit more concerning for the broad market, I think.
All right, we'll watch it. Jonathan, Malcolm, thanks to you both.